Hi, I'm John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant. Welcome back to our weekly Market Insight broadcast. With me today, of course, is Aaron Tuttle, our Chief Investment Officer. Welcome back, Aaron.
John, I'm glad to be here. You will not be here next week.
Next week, we're going to do this remote because I'll be down in Florida visiting clients for the next month, and we're going to do some remote broadcasting.
And we have a stand-in for you while you're gone.
We do. This is kind of what I look like when I get to the office. I turn into a plant.
Right. So I think it will be an improvement.
You're right. No, that's definitely an improvement about this. But a lot's been happening in the news this week, and we had some talk from the Chairman Powell from the Fed this week. We're going to talk about what that means, and because we just hit for the 15th time a new high on the NASDAQ yesterday. So are we getting a bit frothy? Are we getting worried?
I wouldn't say worried, but we'll get into that.
That's what we're going to talk about today, because we don't want our listeners to worry. We want them to be confident.
So last week, you had mentioned the Fed. They've really been in the news and dominated the headlines since the FOMC meeting on June 15th through the 16th, where they do the announcement, where it's 12 individuals, mainly board governors, but also some representatives from the local banks. So St. Louis is not in this one in 2021.
So is this a rotating schedule? How do they determine who's going to be in that?
There is a rotating schedule. So you can see the board of governors will tend to be in each meeting. But then if we look at Raphael Bostic from Atlanta and Thomas Barkin from Richmond, next year, James Bullard from St. Louis will be a voting member.
Gotcha. Okay.
So the regional Fed banks will each take a position to have some voting power on setting the rates.
And then do they have non-voting representatives of banks there as well? Or
there are alternatives. James Bullard, I believe, is an alternative this year. And basically, I think who will be the voting members in the previous year as the alternatives in the current year or the next year. I think that's how that works.
So the big discussion, of course, has been inflation, rates.
Yes.
So how do we see this rolling out?
Well, coming out of this recent meeting, let's look at kind of and target some of the things that were important. So they set a target range for the federal funds rate of 0 to a quarter percent or 25 basis points.
And that's where we are today.
That's where we are today. So basically we're at the zero level. Right? And they also said that until we hit maximum employment and inflation is at or above 2%, the long-term goal, they don't want to raise interest rates.
What is the maximum employment number? What do they consider that to be? 4%?
Historically, 5% is considered fully employed. We've definitely gotten below that. We've seen 3% unemployment rate. There's always some type of rotation within the economy. You do need some people leaving jobs to go to new ones. So it's kind of assumed that that's just a normal noise as people transition employment of a 3% to 5% unemployment, and that's considered fully employed.
And where are we today?
I think we're at 6 or 7. I'd have to go back and look.
So we're still above what the target is.
We are above the target, especially if we were going to target 3%, but not on inflation. If we look, and this is from the report in the meetings, we can see inflation is already well above 2% and is trending down. So when we look at inflation, to not raise interest rates here while inflation is already high is already against one of their mandates. Now they would say, well, we're trying to get full employment, and that's why they would continue to have interest rates low. And then if we look at another part of the statement, the Federal Reserve will continue to increase its holdings. So meaning they're going to continue to purchase in the market $80 billion in U.S. Treasuries and $40 billion in mortgage-backed securities.
So that's $120 billion per month.
Per month.
Where does that money come from?
Well, they print it. They're able to do that.
Are we gonna have to
they don't like it when we do it.
Do we have to pay that
Maybe
back
it comes out of your account. I don't know.
I think it's going to be coming out of my account and your account, and probably all of our clients' accounts.
Yeah, at least our purchasing power,
yes.
Right? And these asset purchases are helped to foster a smooth market and accommodative financial conditions. Now, I find this an ironic statement, because if we were to look at what house prices are, remember, mortgage-backed securities, that is not smooth. That is not smooth.
That's pretty jagged.
If we're looking at the price appreciation, now that dotted blue line is an annualized quarterly change. So house prices based on the Q1 report was up 16% from the previous quarter. That's not smooth.
That's unbelievable.
I don't think you need to help this market at this point. So they continue to purchase this. We continue to have very strong accommodation. I would say the most recent FOMC is really more of the same ahead.
One thing that was interesting this morning, we ran into our banker, and we were talking about the fact that the home price has gone up so much, and asking, so what is the health of the bank? And he said, they haven't had a single past due for quite some time, and that while they see home prices as high, they don't see it as a bubble yet. But what is coming down the pike is they're going to change the back-end calculation of the debt-to-income ratio in the next couple of months. So what that's going to do is to knock out some borrowers. But he said, but what will happen with the free market is that they'll start to come out with other products, right, to get the people that can't get those loans to not be able to get loans. But eventually, that's the type of thing that could lead to an eventual collapse the way it did in 2008, I would suppose.
I would say a lot of banks get beat up on the way that they responded in 2008. I just recently watched The Big Short.
Oh, yeah.
So it's a good movie. And I think it really shows on how difficult it is to be out of favor on a position. But the blame needs to be at the Fed. The reason that things get out of control and the reason that lending standards are lax is because money is cheap. So I think that the blame needs to fall at who's spiking the punch bowl.
All right. Well, back in 2008, we also had public policy that mandated lower standards for borrowers that would not normally qualify.
Right.
So it was a combination, really, of those two that led to the collapse back then.
Yeah. So it's not to say that people are not going to do funny things, but whenever money is just sloshing around and it's very cheap, it invites more fraud. You'll see more fraud.
Yes.
So then more of the same. Now, here's the dot plots.
So explain to our listeners what this dot, because to me that looks like a Pac-Man screen.
Well, connect the dots.
Connect the dots. That's another
maybe
one
it's
we
a
used
scorpion.
to do.
Get my 7-year-old here to help us draw the scorpion there. So what it's looking at is 2021, and basically all voting members assume that the interest rate will be exactly where it is, between the 0 and 25 basis point mark. And then 2022, there are a few of the voting members that think it'll be another 25 basis points high, and there's actually 2 that say it could be up to 50 basis points. And then if we get out to 2023, we can see there's about 5 that anticipate that interest rates could be over 1%. So really what it's saying is the Fed believes that they may raise interest rates 2 years from now.
Well, what's interesting, there's nobody that thinks rates are going to be below 2% higher in the future. In the long run.
Another question in some people's mind on this reaction that the market's having, and we want to talk about that, is those 3 dots that are above the 25 or 2.5%, which is higher than our previous high on interest rates. So that may be 3 people that are voting may not buy the transitory statement that inflation is just this short-term blip. So maybe that's getting portrayed into the dot plots.
Right, but we are seeing some things that are coming down, commodity prices because of the supply chain disruption. But at the end of the day, what most believe and what we believe is that prices will settle in higher than what they were prior to where things were before all this monetary infusion.
Now, whenever we're looking at these dot plot, I think people should think about reading tea leaves because that's about as good as they are.
Well,
this
that's
is just
what we
projection.
do here, isn't it?
It is, for sure. But whenever we look, and let's go back to 2017. What was the Fed governors projecting for interest rates? And we can overlay the Fed funds rate, and we can see that they got the direction. So interest rates were moving up, but they were not moving up to near the level if we were to take the medium dot to say, okay, that's where they should be. You can see that pretty much there's only a handful of dots that are at the level whenever they rise. And that's because it's really easy to raise interest rates in the future. But once that time comes about, it's always, oh, well, are we really at a full capacity economy, or could we benefit for lower interest rates longer?
Right, I guess because they also know that anytime they raise rates, that's going to create a contraction.
It can.
Right?
It can.
And especially if it happens quickly or too high.
Right. And then if we go to 2019, we could see that they assumed that we were going to have this nice move into 2.5% over the long run, and that at 2020, 2021, and we've seen 2020, right? We know that that didn't happen. We went back from the near 2.5% down to 25 basis points because of the COVID crisis.
I think a takeaway from this would be that the trend, they seem to be able to predict the trend. I mean, other than an exogenous event like what we just happened. I mean, those are things that you...
Well, they are the people that make the trend, so...
That's, I guess that could be that it's, it's a self-fulfilling trend,
sure.
Correct?
Yes.
But to your point, that interest rates have not been as high as what they forecasted. And I think it's a very interesting point because of their concern for maybe what that might mean at that time.
Yes. So then if we look at the meeting on June 16th, and what we're looking at here is different indexes of the market. So we're looking at the NASDAQ, which is the red, it's the one that's highest at the end. We're looking at the 7 to 10-year Treasury interest rate. We're looking at the S&P 500 small cap. We're looking at copper. We're looking at gold. And we can see copper and gold, those are the two bottom lines. They sold off on June 16th, and they were already trending lower.
This is since May 24th.
This is looking back 20 trading days.
Gotcha, okay.
So they definitely sold off as we were going into this meeting and sold off at the conclusion of the meeting, meaning that the market is anticipating inflation to pull back, and especially off of this meeting. And then when we look at small cap, that also has sold off, and the thing that's done well is growth. So growth is going back into favor. Another thing that's interesting, though, is this is supposed to be interest rate movements. If I look at the 10-year Treasury, the rates really didn't change out of this. So
how do we look at this when our thesis is that inflation is a risk?
Well, it certainly is a risk. So we're trying to figure out what is the market doing, because a lot of people have interpreted this to be a hawkish Fed. And I'll get into a little bit of why that may be the case. But we're talking about possibly raising interest rates in 2 years if inflation may be as high, even though that the interest rate that we project that we'll raise it to won't be as high as what inflation is to be expected.
And based upon what we just saw, there's a good chance that they won't raise the rates to as high as what they're thinking that it could be,
right.
Even if they do raise rates.
Correct.
Is that the point that you're trying to make?
Yeah, so it's just, I don't consider it a very hawkish Federal Reserve announcement. I think it's a very dovish Fed announcement saying, hey, we at least will go another couple of years before we begin raising interest rates, despite the CPI coming in at 5%. So I'm struggling with this to be a hawkish statement from the Fed, even though that is definitely the way the market has responded to a hawkish, and going back to those dots that were in the long term, those 3 dots. Maybe that's the market's interpretation.
Didn't we have some conversation in the past, though, that when they're looking at this 2% target, that they're looking at 2% over a period of time? So we could even have 5% inflation, but if you average that out over a period of time, it could be 1.5%.
Yes.
So where is that inflection point actually going to become with the Fed?
Let's first look at our history of them raising interest rates. And this is going back to basically the beginning of the 21st century. So for most of the time, we've been at this zero bound. So from 2008 all the way to 2016, we slowly get an increase, and then 2020 we're back down to zero. So the Fed has historically kept these interest rates really low over the last time, and I don't think that's going to be that different going forward. And then when we look at inflation, you would expect inflation to be low over that time. We've been at 0%, but it's not necessarily been low. We see the 16% trimmed CPI, which is the red line. Now, what is that? That's 8% of the numbers that are high, 8% of the numbers that are low in the CPI are just simply removed. Takes the noise out.
So they're taking out the outliers,
yes.
Which, although they may be core products, it's whatever it is that is an outlier at that moment.
So in this recent CPI, where a lot of it has been the used cars increase, that would just get removed. So that's just noise, and let's just figure out what the thing is. And that does a really good job of kind of getting the base CPI. What's the What's the stuff in the middle? And we can see that that's been over 2% since 2016 and have been running above that. And for the most part, except coming out of 2008 in that recession, it has stayed above 2%.
How does the Fed look at the trimmed CPI versus the CPI that they're targeting?
So they use the PCE, which is the change CPI, and I won't get into the math on that, but what change CPI essentially does is it biases the number down or lower. So you can see that the PCE is continually coming in with inflation that is below what that trimmed CPI is.
Would that mean that for us as consumers, things actually are going up higher than what the Fed is stating inflation to be?
Yes, especially depending on what demographic you're in and what you spend on. I would say that that's an accurate statement.
Well, I had breakfast this morning with Brian McGeehan, who's our CFO and lead advisor, and he was talking about how much more he and his wife are spending for their 3 little kids, and they're not buying anything different.
Yes.
But it just seems that the prices continue to climb, and they're astonished at the rate, at how fast those things have climbed.
Yes. Well, kids are expensive.
Kids are very expensive.
Especially during inflationary times.
Even more expensive.
So the idea that inflation is not here, I don't see it in the data. But I don't think the Fed is going to respond by raising interest rates. Let's go back here. They've kept them down to near 0 to 25 basis points. But nonetheless, the market is responding as if this is a hawkish statement. So we think that inflation risk is certainly high. Now that doesn't mean that we don't see a pause in inflation. One, high prices solve high prices. We've been seeing commodities pull back. Now, one of it thing is that China has been releasing some of their strategic reserve of commodities, helping to put some downward pressure. You can only do that so long. And then you run out of your strategic reserve, and then prices continue to move back up. The CEO of Glencore, which is a major commodity company, has said that no, he thinks that there's going to be a little bit of a breather, but commodities will stay elevated, especially since China is going to be doing a big infrastructure bill, and the U.S. is likely to do a big infrastructure bill.
Well, one thing that I was just noticing here on that prior chart was that, so interest rates prior to 2000 were 5-6%, okay? We then had the dot-com bust, right? Then we had 2008, now we had the pandemic. So rates would rise just before those, and then they went back down again, right? Would we, I guess, first of all, is this something that has happened in the past with prior recessions in terms of the Fed response? And is this something that we would expect going forward, that it's going to be a more protracted time period in which they're going to be accommodative because of the fact that there was some prior recession, and maybe people are thinking, oh gosh, I don't want to go back to that?
So I would say the business cycle is caused by the Federal Reserve on their movement of the interest rate. That 12 individuals, as smart as they are not able to set the interest rate to what the appropriate rate should be based on how complex the economy is. Whenever they set it too low, you can overstimulate the economy, and eventually you can get inflation. There is some technology that helps offset that. But at some point, as they raise interest rates to try to slow that inflation, you hit an inflection point, and all your previous plans that were set at lower interest rates no longer make financial sense, and they have to be pulled off, and then that's the correction. So yes, I would say that there is a relationship between that interest rate and the cycles that we go through.
So I was reading Brian Bolio, who is one of the partners at the Institute for Trend Research, one of the think tanks that we subscribe to, and he was talking about how we may have a pause in inflation. In other words, that we had this initial spike. What was transitory was only maybe this initial spike, but things are going to settle down at a higher level than where they were before. But because inflation sometimes takes time to get through the system. In other words, it starts at the producer prices, they produce the goods, and eventually goes over to the consumer, and then wages are going up, right? And so it's kind of a cycle, and it takes a while for that full effect to take place. but that it'll settle in, but then it'll be a long-term trend after that of continual increase in inflation. Would you agree with that statement?
Yes, I would agree with that. There's also just kind of a behavioral component. And I was actually reading about hospitals on uncompensated revenue, which is a odd statement, but I get what they meant by it. But I think it's also kind of shows this behavioral component where, let's say that there's a facility charge of $100,000, but because you have insurance, it's only $20,000. So man, you're getting quite the deal, right? So I think that, and you would react, just $20,000. Well, if they would have started off with $20,000, you would have been, well, that's ridiculous.
That sounds like the MSRP for anything that's out there. The manufacturer suggested retail price that nobody ever pays. And if you pay that, it probably wasn't the best deal.
If we get into a high inflationary environment, be expected to see a lot of corporations come out with very high prices and then deep discounts. Because if you did get into an environment where we had price controls, you could say we've always charged $1,000 for this meal. We're always giving you $950 worth of discount. We just took the discount off.
But guess what? We're going to double the price, but we're going to keep the discount.
Right. So I think there's a psychological component that's at work. So if you think about somebody that was thinking about increasing their facilities, and they saw the price of lumber and steel and all this, and now it's 30 to 40% off of those highs, well, that might be a deal to them.
Yeah, this is one of the contributing factors in economics that's interesting to see because it's not a mathematical number. It's markets that are behaving because of human behavior.
Yes. It's people trying. All our numbers are ordinal, not cardinal, and it's really hard for us that want to just have a formula to remember that.
That reminds me of a great book that you had me read one time by Mandelbrot called The Misbehavior of the Markets.
Which I guess it's really just the misbehavior of us humans.
Right. We're the ones that are misbehaving that are causing it to misbehave.
So one thing that I think is actually happening here, it's not so much, and I could be wrong on this, maybe the market is right and they're calling it a hawkish Fed. I know Chris Ahrens would advocate that is true. I wonder if the market is just starting to see a correction. So if we look at our price point, this blue line is an arc that's known as rolling over. Now, we could bust through this high and all of a sudden this technical indicator doesn't matter anymore. But we breached our 50-day moving average, meaning that's the 50-day price, and we've rebounded. And if we can't get enough inertia to just kind of propel us out of this, then I think a correction's going to happen. And if that happens, this is not run from the hills. We would probably go to 40-50. As the first stop, and then possibly 3,900 on the S&P, or all the way down to 3,750, going through the 200-day moving average of 3,086.
So what would that mean for our portfolio management?
Well, one, we are making changes with the anticipation of this possibly happening, because even if we break through, it's most likely growth is going to reassert itself, but if we were to have a correction, growth is probably going to hold up best. It's been over the last decade that growth has actually been the defensive area. So we've been adding our growth position, which has caused us to struggle most of the year, where it's been this value rotation, back to growth, back to value. Well, we're starting to finally get out of that back and forth where it looks like growth is reasserting itself as a dominant position. And if we look at our...
that might have been because of just the uncertainty of where interest rates were going, do you think?
No, what's interesting is we look back to November 6th, whenever the value rotation started to reassert itself, and what happened a couple of days before that? We had an election. So it may just be the administrative change where things were reshuffling and money was trying to figure out what is going to benefit from a new administration.
Oh, that's an interesting observation.
So that's whenever this started, and it looks like growth is now coming back to winning the capital. And think about ESG and other types of investing that is favored by the administration.
Technology, right?
Yes,
I mean, technology is going to be a huge driver for ESG.
So it seems that it was the market trying to digest a new administration. If we look at our technicals, we can see growth, so that those are the green. Large cap growth is back in favor after spending quite some time below. Mid cap is now below the medium mark. Small cap still up. Emerging gold is down, and commodities are starting to pull back. So we've actually decreased our exposure to mid cap. These are easy and qualified accounts, but we actually did it in tax sensitive as well. And we are finding areas that are more large growth and trying to still walk around some of our concentration that we have in tax sensitive. But when we look at our performance last week, even though it was a down week, we in our taxable accounts where there's growth held up much better. So tax sensitive gained 117 basis points against our benchmark. The tactical mutual fund lost a little bit, about 80 basis points. We've made some changes there. We're up 15.5%, and if we can continue to gain if growth comes back, we're very happy with this. Tax sensitive is not doing as well at 15. We'd be happy to lose 80 basis points if we go back to 15.5%. But we do think that there's a strong likeliness that growth has now reasserted itself. So hopefully we'll be quickly gaining on our benchork over the next couple of quarters. So that will be the presentation today, unless you have some other questions.
That was very enlightening, and it's just an interesting time where so much of the market now depends upon what the Fed is saying, not just what they're doing.
I saw a couple of articles, and one was from Morgan Stanley, which is now noticing that the money supply has a strong correlation to the market performance.
Right, that was an article in Zero Hedge, right?
Yes, so it was interesting to see other people start to recognize that money supply, specifically money supply growth, matters for where the market is, considering that it's really been the Fed inflating this market, and they will continue to do so. I have some qualms on the way that they were calculating it. I think we have a better way. I'm certainly not going to share with Morgan Stanley.
No, but I think that you guys do a great job, and of course that is part of our mission, right? That we want clients to not only become, but remain financially self-reliant. And as we know, these types of monetary policies do lead to ultimate market disruptions, recessions, and so we'll be ready to make whatever changes that we have to as things do change to make sure our clients are in good shape. So thanks again for joining us today, and I'll be seeing you remotely next week. Now, of course, typically what happens in that presentation is that there's a little bit of a delay because we'll be using Zoom, but we'll be using Zoom on steroids because Jess, our amazing production manager, she's smiling there in the background, has equipped me with incredible cameras and microphones, so hopefully I'll be able to figure that out. But
we have the plant here.
And we have the plant to replace me. So thanks again for joining us today. If you like what you heard today, we appreciate you sharing that with your friends by pushing the share button at the bottom right of your screen. If you haven't subscribed already, we always look for having more subscribers so you can be alerted to the weekly market commentary and our daily
3x3.
And what do we do there?
We cover the three main topics in the market in 3 minutes or less.
So thanks again for joining us today. We hope that this is relevant content to you so you can have actionable advice for your portfolios and your financial plans. And we look forward to having you back again next week.